Hello and welcome to ET Insight, where we get you a 360-degree view of the big picture in business and economy. I am Sridharan Ramakrishnan, and here's what we have for you on the show today. Micro-lending in India is in for a major overhaul, all thanks to the new microfinance bill. We look at the fine print of the draft. Both borrowers and lenders are heaving a sigh of relief. We'll tell you why. And will the new norms pave the way for consolidation in the microfinance industry? Our top story first. India's 25,000 crore rupee microfinance sector has been mired in controversies these past few months. The MFIs have been accused of being everything: callous, exploitative and even murderous. And now there's a new regulator, the RBI, which will oversee the microfinance industry. Will that change things for the better? Asha Gopalakrishnan hits the road for answers.
Million rural poor with a myriad number of needs. Serviced by 50 for-profit microfinance institutions. Institutions that have empowered the poor and those that have rewarded investors and promoters handsomely over the past few years. But this free run, which has lasted for over a decade, is now on its last legs. And a draft microfinance bill will soon clip the wings of MFI sector. And it's about time.
The bill in its present form makes Reserve Bank of India as the sole regulator, so therefore it adds to the regulatory clarity brought in by the Malagam Committee and further notification from RBI and Murthad. This benefits of sole regulator is immense.
Sure it is, because so far microfinance institutions had to follow a different set of rules and regulations for every state they operated in. For instance, in Andhra Pradesh, they are governed by the Andhra Ordinance, and in states like Kerala, MFIs are regulated under the state's money lending regulation.
Having different regulations in different states will be very, very expensive, and like with this ambiguity, we will end up like not really complying with any of these regulators. It is going to be extremely difficult, and this sort of uniformity amongst all players and even customers at the ground level would get clarity.
Most states have ad hoc regulations because they were not prepared for the growth of the sector. A decade ago, most MFIs were set up as trusts and non-profit companies, but the unprecedented growth of the sector led most MFIs to have operations similar to those of non-banking finance companies. But since these companies were not raising deposits, they were by and large unregulated. That's because only deposit-taking NBFCs were subject to prudential guidelines. Soon, many MFIs started using roundabout means to offer surrogates of savings products. For instance, some MFIs sold savings-linked insurance products and offered reverse saving products like gold, where the MFI provides the money for gold purchases and the borrower repays the money to own the gold at the end of a predetermined period. All this led to a big mess of multiple loans and over-indebtedness.
There was very aggressive growth and lending for the last 5 years. Basic disciplines of microfinance were forgotten.
The crisis took an ugly turn in Andhra Pradesh last year when the state alleged that MFIs were using coercive recovery mechanisms, which in turn had led to several suicides. Soon, micro-lending activities in Andhra Pradesh came to a grinding halt. The blow was a big one for large MFIs because the state comprised nearly 25 to 30% of their portfolios. A few months later, the Andhra Micro-Lending Ordinance was enforced.
Portfolio and outreach of MFIs have come down drastically, and because of that, even the financial sustainability of some of the MFIs, which are of middle-sized or smaller size, have come into question.
These have had some impact in the sense that banks' funding has slowed down, and that's reduced the entire growth in the sector. And I think to that extent there has been some amount of impact.
To date, every credit application in Andhra Pradesh has to be individually approved by the state government. The problem is massive and the wait for the approvals is never ending. And the proposed bill is a ray of hope for an industry that has seen lending in the state dry down to a trickle.
There needs to be an alignment of the rules of the game in such a manner that the banks seek a continuity between their reporting standards to the existing regulator and the reporting standards on this new portfolio that they are going to be developing with microfinance institutions. So I think a uniform regulator is always welcome.
That's because the Microfinance Bill proposes to empower RBI to issue directions on margin caps, loans, processing fees, etc. It makes it mandatory for every MFI, including the existing ones, to register with the RBI within 3 months of the commencement of the Act. The draft bill states that any institution with a minimum level of capital or net owned fund of 5 lakh rupees should be registered with the RBI, and larger MFIs will have to register themselves under Companies Act. And last but not the least is the fact that RBI will have complete power to ask MFIs to cease activities if warranted and cancel registrations if required.
There is a need for a proper regulatory framework to exist which addresses the issues that relate to all the stakeholders. And the stakeholders include the customers, the stakeholders include the shareholders, the stakeholders include the banks and the funding agencies that provide the funding, and the stakeholders include the larger society and the system.
Given that the regulatory uncertainty that has covered the entire industry, it is very important to have one powerful regulator, and the industry should be entrusted with that powerful regulator.
This is not the first time that the government has spoken of increasing vigilance and introducing uniform laws for the microfinance sector. In 2007, it proposed the first microfinance bill which spoke of NABARD and state governments jointly regulating the sector. To the industry's relief, the draft lapsed in 2009, even though the bill was tabled in Parliament.
The initial recommendations on, that go back to the Maligram Committee report and bringing in caps on rates and spreads that the RBI has already recommended.
While everyone agrees that the latest draft of the microfinance bill is the need of the hour, they are afraid that the RBI may land up micromanaging more than required. For instance, the new draft says that RBI must decide on the maximum amount of loan, term or tenure of loan, periodicity of installments and the location of transactions in the MFI business. Critics point out that the bill seeks to set a regulatory framework but does not do justice to the very purpose it came about, customer protection. For instance, the bill states that the RBI will regulate and cap the margins of MFIs but will not regulate interest rates, which is actually the bone of contention. That's because some MFIs charge as high as 40% interest but show a margin of just 6%.
Interest rates from banks to MFIs have gone up between 2 to 3%, 200 to 300 basis points. So now if you have a fixed outward interest rate and not a fixed inward interest rate, then there's a problem. So the best way is, knowing that bank interest rates will keep changing, is to put a margin cap. So which is also in the spirit that the Maligram Committee recommended. So interest rate cap is ensured by the fact that there is a margin cap.
Part of that problem can be sorted out by providing the sector with low-cost funds, and the draft bill recognizes that. It talks of the setting up of a microfinance development fund constituted by RBI to provide loans, refinance, grants, seed capital or any other financial assistance to any MFI. The fund is expected to enhance funding opportunity and augment the flow of credit to the sector. That then sums up what the new microfinance bill proposes to do and why.
So what has the industry learned from its rough patch? Is it engaging differently with its poor customers and becoming more efficient to drive down its own lending costs? We'll get you that story after this short break. Stay with us.